What would you do if you discovered your aging parents' portfolio was full of underperforming mutual funds and high fees? Easy, right? Just sell them off and shove them into a better mix of low fee ETFs and be done with it. Well, unfortunately, it isn't always that easy, as this Canadian Wealth Secrets listener found out as he was later given a nice large tax bill that's going to cost about $200,000 in capital gains taxes. Let's dig into another Canadian Wealth Secret Seeker case study around a good problem to have and a good problem worth solving, which is building up large gains on your investments over your lifetime and how you slowly decumulate them in the most tax efficient way. Here we go. All right. So today, my friends, we are going to be diving into a situation. We have a listener, Andrew. He lives out in BC. His father lives on the East Coast. He's originally from the East Coast, and his father had a large portfolio, over $2.5 million. And this particular individual reached out because he wanted a little bit of feedback and really some strategy on what he should do next. Because what he recognized immediately was that these $2.5 million of assets were passively being managed by, and really what I think he wanted was active management. However, they were being passively managed by a wealth management company, a name I'm not going to mention, but let's just put it this way: they have their name on some big buildings across Canada and even some sports arenas. And unfortunately for this particular individual, his father, who is older, in their 80s, really has just done a set and forget it sort of strategy. Now, here's some of the challenge is that, this particular individual, Andrew, feels like the actual advisor wasn't actually serving his father well, or his family, or his interests. However, we actually don't really know what those conversations looked like and sounded like, right? So we don't understand if maybe, this advisor had done some things in order to determine, what's his risk capacity, what's his risk tolerance. I would argue that his risk capacity is quite high. He has quite a few assets. He's a very low spender, this individual. However, his risk tolerance could have been very low, right? So we don't really know what had happened there. However, as I've done as well with my own family, my own parents, at times I've looked at what they have going on and sometimes questioned why their advisor that they had been with for many decades had done X, Y, or Z. Today, we're going to talk about not about whether the advisor did the right thing or not, but rather what he can do now that he's sort of ripped the Band-Aids off, as well as we're going to give some guidance to those who may have not yet ripped a Band-Aid off to decide whether ripping a Band-Aid off is the right move or if there's something else that we could do. So ultimately, what had happened when Andrew had looked at these accounts is that he felt that the advisor had put his father into some pretty poor investments, right? And again, for those who look at, low fee ETFs, for example, it's very easy for us to say, you know what, there's a high MER, or management fee, on this mutual fund, and we could have done something better with an index ETF. Now, keeping in mind, when we look at ETFs, usually that's a little bit more self-managed. There are advisors, there are firms out there that will use just ETF strategies. Sometimes there'll be a fee for service. Sometimes they will still take, 1.5% off of the total assets under management. So it's really important for us to recognize that when we go to, say, a big bank, how the big bank is paid is by a larger MER fee. And they use those fees to help pay some of their employees. They get salaries and sometimes bonuses and so forth. However, on the other end, if you go to a firm that's charging for assets under management, even if there is a low fee ETF in the portfolio, there's still more to be taken because the firm itself is also going to be taking a fee off the top. This is something that every investor has to really think about along the continuum from how passive or how active do I want to be in managing my portfolio. I think it's important for everyone to have at least a baseline understanding of what's happening in order for you to then decide what makes most sense. The same is true when someone gets into real estate. A lot of people get in and think real estate, I'm going to be great at it, I'm going to love it, and I'm going to invest. And therefore, I'm just not going to pay for any property management. However, many people, like myself included, recognize that, you know what, it's hard work. And with that work, sometimes that stress isn't worth it. Sometimes the time and energy isn't worth it. And therefore, you're happy to pay a fee to someone else to do that work for you. Property management can be 7 to 10% of the net revenue coming in on a rental property. So if you want to talk about high fees, that's a high fee, but it's very active work, right? And not having that call on New Year's Eve that the water tank is leaking as it did to us a few years ago in one of our units, knowing that I don't have to deal with that is worth that to me. The same is true when we're looking at a portfolio in the stock market. So just want to make sure that everyone's not just resorting to this low fees is always the right move. Low fees is always the right move if you are willing to take on the responsibility, the full responsibility of your portfolio. That would definitely make a ton of sense, right? So in this case, I don't know what the exact fees were. I don't know what the actual assets were that were invested, or what these mutual funds were designed to do. However, Andrew went in and said, you know what? We're getting rid of all this stuff, and he sold it all. Now, I've been there. I get it. I want to rip the Band-Aid off and I want to sort of start fresh. Now, I should also mention that they were trying to also gift much of this portfolio to this individual, to the son, because the father actually didn't need these funds yet. And they were thinking of a way to try to make this transition a little easier. I think the thought is that if and when, well, not if, but when the father passes away, this could happen anytime. We don't know how long we're going to be here for. It could be today. It could be 20 years from now. It could be even longer. Now, when that happens, we are ripping a Band-Aid off at that time, whether we like it or not, through a deemed disposition, right? So ultimately, at the end of the day, if we're not doing something to transfer some or all of these assets over to Andrew, it will eventually happen whether you like it or not. So that is really important to note here. The one nuance that I want to mention, though, is that sometimes pulling that Band-Aid off all at once now may not be the best option, even if those assets were in some mutual funds that maybe weren't a great fit. For example, didn't give me some numbers, but he did say that those mutual funds historically were underperforming the market. Now, when we say the market, are we talking global market? Are we talking the TSX? Are we talking the S&P 500? Are we talking the Russell 2000? What are we talking about here? That was not mentioned. However, when we look at those mutual funds, depending on what they were designed to do, for example, if they were designed to be more resilient in market downturns, it would make sense that they're going to underperform the market because you're going to have more risk-off assets included in that bucket. So there's a lot of moving parts here, but what I'd like to address on this episode is what we might have considered doing differently. Now, it's all after the fact. So these gains have been crystallized. Okay. They have been crystallized. There's, sort of no going back. However, he wanted to know, was there something else he could have done to rip this Band-Aid off? So one thing that came up in the discussion was around the lifetime capital gains exemption for business owners. So these funds were inside a corporation because his father was a business owner along the way. Now, that business has since ceased to operate actively. However, the corporation was left and it became a holding company or an investment company. So those funds were inside of that company and continuing to grow and accumulate. The problem is that lifetime capital gains exemption is really only helpful for small business owners that have active income. So it actually has to be an active operating business. It can't be an investment portfolio. It even can't be a real estate portfolio, right? Even though I would argue there's a lot of active work that goes into real estate investing. It's not going to work for that. So we can't apply the lifetime capital gains exemption. You'd mentioned things about rollovers, for example, like rollovers, like a Section 85 rollover, for example, is usually something that we turn to when we're trying to roll shares over for a specific reason. Now, one that comes to mind is for the lifetime capital gains exemption. holding company might own the shares of the operating company. We might have to do a rollover so that the actual business owner himself once again owns those shares, so that that lifetime capital gains exemption can be utilized. So that's not going to work here. Also, we're stuck because we can't actually just gift these assets over without triggering a capital gain. All right. So gifting there's no tax on gifting. However, in order for the gift to be made, the liquidation of those assets has to happen, right? If we transfer the assets in kind, meaning leave the assets invested in the mutual fund and then actually transfer them over, there's still going to be a capital gain triggered at that time. So that's not really going to be helpful. So really, there was nothing better that could be done here if the ultimate decision was that we're going to rip this Band-Aid off, okay? However, what I want to think about is some ideas that we might have considered. Instead of the rip the Band-Aid off mode, I would think that phase selling at minimum would have been a good move here. And each and every year, if we could do phased selling in order to take on less tax liability each year, that could be really helpful. So what I mean by this is when we sell a large amount of anything and there's capital gains, we're essentially going to be putting ourselves in the highest tax bracket in that given year, right? So even though we're only going to pay 50% tax on the capital gain, sorry, let me say that again. Even though we're only going to pay tax on 50% of the capital gain, okay, very important to note, it's not 50% of the capital gain that is tax. We're going to only apply tax to half of the gain. So half of it's tax-free. That's great. That's fantastic. But the other half is going to be considered income, and therefore we're going to have to pay tax on that. And that in the highest tax bracket is going to be at about, depending on where you are, 25, 26, 27%, depending on the province that you're in. So still not horrible from the actual tax rate, even if you're in the highest tax bracket. However, what if we could do phase selling and slowly sell some of these assets over time so that the capital gain that is triggered is less, and we might even be in a lesser tax bracket. So for example, if, as he said, his father doesn't spend a whole lot of money, if he doesn't spend a whole lot of money, maybe there's an opportunity there for us to take less income from other aspects, right? So for example, he's getting his old age, his old age security, he's getting his CPP, he's getting all of those things automatically, but he doesn't have to take any income from RRSPs or RIFs or, any of these other registered buckets, right? So if we can do phase selling in order to have him live from some of this phase selling, so that covers his lifestyle, and the remainder can then be reinvested into the asset that you were looking to reinvest into, we could do this slowly over time and potentially lower that 25, 26, 27-ish percent on the entire capital gain that we're paying in this particular scenario, right? So over time, we can do that, and slowly phase out. The other thing we can look at is being very specific about what we're selling. So if we look at any sort of assets that are, maybe have some sort of loss associated with them. Now, with these mutual funds, and assuming they're the same mutual funds that he's owned for many, many, many years, maybe even decades, it's unlikely that there's any loss to be harvested there. But it's worth noting for everyone else who's listening that this could be something that, you could take advantage of if you were ever stuck in some sort of situation like this. Now, the next part, and I think probably one of the most important parts, is thinking about where these assets were held. So if it was I think in this case, it was $2.5 million of investments inside the corporation. So again, there's nothing you can really do about those $2.5 million. But for anyone else who's listening, should be looking at the different buckets that you have. If you've noticed that all the buckets have assets that you don't like and you want to sell them all, keep in mind that in a registered account, this isn't going to be an issue for you as long as you're not removing them from the registered account, right? If you are removing those funds from the registered account, specifically RRSPs or LIRAs or RIFs or anything like that, there will be capital gains, or I shouldn't say capital gains, but income tax triggered at the personal level. If it's in your tax-free savings account, you can sell the assets, you can pull them out, you can put them back in within the next year, right? So just make sure you don't over contribute. You can't remove and then put it immediately back in, but you can get that room back in the following tax year. So with registered accounts, there's a little bit of flexibility here. Once again, not super helpful for Andrew and his father in this particular case. Now, here is the final piece, and probably the most important piece that I think has to be considered before we do any sort of rip the Band-Aid off approach, regardless of whether it's in a corporation or in an unregistered account at a personal level, whether it's real estate. It doesn't matter. If there's going to potentially be capital gains, we need to really ask ourselves this question. And it might sound simple, but is the move worth it? So what I mean by that is, what is the upside of the new investment? We need to quantify this. We need to get our head wrapped around when we look and see high fees and we see maybe a lack of performance in the market. You need to quantify that so that you can actually analyze how much is this going to save me over however many years, over 1 year, 2 years, 10 years, 20 years. What is the timeline that we're looking at? So is that new investment and getting all of those funds in there today, is that enough to justify the six-figure tax bill that we've just triggered? So for example, if we are just moving from mutual funds that were, and I'm going to assume these are balanced mutual funds, so there's a little bit of everything in there, and the goal here is to try to limit downside risk. There's a very specific purpose for selecting that type of asset. Now, if you're moving it all into the Qs, right? So the NASDAQ, where Amazon, Google, Apple, MicroStrategy, and all of these other big tech firms are, of course, the returns on that market or that particular index is going to be higher typically over time. However, the drawdowns are going to be much larger as well in down years. So the question is, what is the upside going to look like? And the last piece that I want to share on that is that we can actually quantify this by just running some very quick numbers. Now, we do need to know a few things. So what I'm going to do as well, if you're on YouTube with me, is I'm actually going to share the screen here. So that should be coming up for those who are on YouTube in just a second. But ultimately, what we're going to do is we are going to look at a quick spreadsheet here. This spreadsheet is the ugliest spreadsheet you're ever going to see, but it's a really important one. And it doesn't have to be fancy in order to run some quick numbers and try to figure out whether ripping the whole Band-Aid off now is really worth it. So in this particular case, we started with about $2.5 million. And if let's assume that the mutual funds on average were earning, say, 7% per year. I don't know what that number is, but here's the nuance. It doesn't actually matter what that number is. Okay. You can put in whatever number applies to your situation. What you need to see is, what's the arbitrage? Like, what's going to be the difference when I put these dollars into another asset, right? And how long is it going to take? So what I've done is I've shown at 7% a year. And again, we can adjust this. We could change that to 5% or whatever percent. It doesn't matter. And then what I have here is going up by 1% increments to show the difference on the lesser amount. So that $2.5 million turned into about $2,270,000 just south of it, after paying the capital gains tax that was applied for ripping the Band-Aid off. So if I apply an 8% growth rate on that, that's a 1% difference, right? So if it was all about MER fees, for example, and it was only like, let's say 1%, you'll see here that the new investment with lesser dollars, it's going to take about 11 years before you supersede what the current investments were doing. In this case, if that was the difference, if it was a 1% arbitrage, the question is it worth doing that and then waiting 11 years to see a positive result on ripping that Band-Aid off? And I would argue the answer is probably not, right? I could slowly inch my way into this new investment, especially if it's in the market and it's just ETFs, for example. Now, if it's a building and a lifetime opportunity in real estate, or there's some big opportunity, then 100%, you're probably looking at higher growth rates and a larger arbitrage between what you were earning and what you could be earning in this new investment. Once again, probably higher risk though, But if you're willing to take on that risk, that might make sense to rip the Band-Aid off. So what you're going to see here is that as we inch up from 8% to 9% to 10%, all the way along, you're going to see that the timeline to break even actually moves up quite significantly. So when we go up to 9%, that's a 2% increase from what this person has been investing in so far. Now you're going to start beating the current portfolio after 5 years. It'll be in year 6. When we go up by 3%, it'll be in year 4 when you start beating. When we go up 4%, it goes to year 3. Now, right here, you might be like, okay, so if there's like a 4, 5, 6, 7% arbitrage, which again is probably kind of hard to do in a lot of cases. But if so, you're like, okay, now the runway's not that bad. But you'll notice that the runway sort of stagnates a little bit. So a 4% arbitrage, that means 11% per year. It takes you into year 3. A 5% arbitrage, so 12% instead of 7%, is still in year 3. When we get to 13%, which is a 6% arbitrage, it's year 2 when we start to grow. And that stays stagnated from 13% all the way to 17%. So like a 10% differential. And it's still going to take you into year 2 before you're going to start superseding what the current portfolio was doing. Now, above that, we move into year 1, right? And things start escalating. So the real question is how long of a runway will it take before doing this action is actually going to start putting me in a positive arbitrage situation from the actual asset that we've sold and its value today? And I would argue in this particular case, it probably, and again, it's only an assumption, but I'm going to assume that a slow drain on some of these assets and a slow shift into new assets probably makes more sense, so that you could keep more of that capital gain from triggering and spread it out over more years. It might still take you 6 years before you're fully in, right? Or maybe even 10 years before you're fully into this new quote unquote ETF or asset or whatever it might be. But by saving and saving more tax dollars, or at least deferring more tax dollars in the meantime, you'll be able to continue growing a larger amount of money at a lower rate as you're slowly scaling into this new investment. So, friends, if you've been in a situation like this, or you have a situation like this coming up, feel free to reach out to us over at the Canadian Wealth Secrets website. We so appreciate people dropping us these great questions. Sometimes they come in through email, sometimes they come in through a discovery call. If you'd like to see what your next best step is along your journey, head on over to CanadianWealthSecrets.com/pathways, and you'll be able to figure out which phase of the 4 phases in your wealth building journey you are in currently, and some next steps to keep you moving in that direction. If you're ready to hop on a discovery call because you've got specific questions or next steps that you'd like to work with us on, head on over to the discovery page at CanadianWealthSecrets.com/discovery and book yourself a discovery call. Of course, we love ratings and reviews. We so appreciate everyone who takes the time to hit whatever rating button they think is appropriate on their podcast platform. And of course, leaving us a comment and subscribing on YouTube is super helpful. All right, just a quick reminder, my friends, that this is not investment advice. It is not tax, legal, accounting, financial, or investment advice, and that you should only be taking this information for educational and informational purposes only. And as a reminder, I am Kyle Pierce, and I am licensed as a life licensed accident and sickness insurance agent, and I am currently the VP of Corporate Wealth Management over at the Pan Corp team, which includes corporate advisors and Pan Financial.